Hello everyone. In this video we will analyze the payoff of linear assets. We will deeply analyze the graphic chart of risk-reward of our portfolio, made of assets such as stocks, ETF, futures, commodities, currencies. This particular chart is showing how much a position can gain or lose as a function of the price movement of the underlying. I would like to begin by saying that, from now on, we will name this asset underlying due to the fact that we're analyzing derivatives. Typically the underlying is an index and its derivative is named future. So let's go back to the heart of the matter. The risk profile is a chart in which the vertical line of the y-axis represents the levels of gain or loss of the position. Instead, the horizontal line of the x-axis represents the price levels of the underlying instrument. As you can see, the horizontal axis meets the vertical axis at the 0 point, which corresponds to our entry price. It is the situation in which the position is even. This chart is also called payoff. It is used to understand exactly what risks our portfolio is running in relation to our choices. As you know, when we enter the market, we can take a long position, buying a future at a certain price and reselling it when the price has increased and thus obtaining a profit. Or we can take a short position, selling short. That is, selling a future at a certain price and then buying it back when the price has decreased. In the first case we will talk about a long position, or a buy, or long. In the second case, we will talk about a short position, or short sale, or short. Let's now look at the risk profiles of these positions. The strategy is simply to buy shares, ETF, or futures. You enter the position assuming a general prices increase. The risk profile is perfectly linear since each point of movement of the stock corresponds to an identical movement of the portfolio. In the example, we simulated entering the market with a long future when the price beats 1,000. Each point will correspond to an equal movement of our portfolio. Should the price rise from 1,000 to 1,100, we will earn 100. Should the price decrease from 1,000 to 900, we will lose 100. The profit is therefore due to a rise in the underlying price, and our loss is due to a fall in the underlying. The break-even point is represented by the entry price of the position, that is 1,000. Short future position is exactly the opposite of the long future. The strategy is based on selling, going short, stocks, ETFs or futures, and then buying them back when the market price has decreased. This strategy is used when we plan a reduction in the price of an asset. We will profit on the falling of the price, and we will accordingly lose if the price of the underlying instrument rises. Also, in this second strategy the profile risk is linear. Assuming we take a short position at 1,000, if that price decreases, we will start making money, but if it rises, we will start losing money. Our break-even is the short entry price at the moment we open the position, 1,000. This first example of a payoff is useful for us to understand the huge differences between a payoff based on future and a payoff based on options, where a new variable comes into play, which we will discuss later, the at-now curve. Well, thanks for watching, see you next time.